In contemporary economic systems, particularly within the United States, tax revenue serves as the backbone of governmental operations, funding essential services across federal, state, and local levels. The primary sources of this revenue vary by jurisdiction, reflecting distinct priorities and economic activities. At the federal level, individual income taxes dominate, comprising over half of collections, supplemented by payroll taxes that support social programs. States often rely on sales taxes as their leading source, while local entities, such as cities and counties, depend heavily on property taxes to finance community needs like education and infrastructure. This stratification ensures a balanced approach to revenue generation, where broader national economic output fuels federal coffers, and localized consumption and asset values sustain smaller governments. The interplay among these sources underscores how economic activity, from wages to purchases, forms the core of fiscal sustainability, with no single industry emerging as the unequivocal leader but rather a collective of sectors contributing through employment and profits. Beyond these immediate sources, the foundation of taxable economic activity lies in meeting basic human survival needs, which enable the proliferation of diverse goods and services. Food, as a fundamental requirement alongside air, water, and shelter, historically and philosophically anchors societal development. In agrarian eras, agricultural output was the primary taxable base due to limited consumer diversity, but modern policies have shifted toward exemptions or reduced rates on essentials to promote equity. This approach allows surplus resources to flow into non-essential sectors, fostering innovation and higher value exchanges. The resulting economic diversification creates layered taxation opportunities, where income from varied industries, finance, professional services, healthcare, generates substantial revenue through individual and corporate levies. Such dynamics illustrate how securing basics propels a snowball effect, expanding the tax base through increased consumption and earnings. Ultimately, the evolution of taxation from ancient tributes to progressive income systems highlights a transition toward multifaceted economies. Introduced in response to fiscal demands like wars, income taxes have become the predominant funding mechanism in many nations, including the United States, where they encompass individual, corporate, and related categories. This structure not only captures the fruits of economic growth but also recirculates funds into society, reinforcing cycles of activity. By prioritizing affordability in essentials, particularly food, societies unlock potential for broader fiscal contributions, ensuring resilience and equity in revenue streams. This framework reveals taxation not merely as extraction but as an enabler of prosperity, where foundational elements sustain complex fiscal architectures. Primary sources of tax revenue across government levels. Tax revenue distribution in the United States exhibits a clear hierarchy aligned with governmental responsibilities, ensuring that each level addresses specific fiscal needs through tailored mechanisms. Federally, individual income taxes constitute the largest portion, often exceeding 50% of total receipts and reaching up to 55% in recent fiscal years, drawn primarily from wages, salaries, and investment earnings across the economy. This dominance reflects the federal government's broad oversight of national economic productivity, where taxes on personal income capture the fruits of widespread labor participation and capital gains. Payroll taxes follow closely, accounting for approximately 30 to 35% of federal revenue, dedicated mainly to funding Social Security and healthcare entitlements like Medicare, which are essential for long-term societal welfare. These taxes are levied on both employees and employers, emphasizing a shared responsibility model that ties revenue directly to employment levels and wage growth. Corporate income taxes contribute a smaller but significant share, around 8 to 10%, sourced from business profits in sectors such as technology, manufacturing, and finance, while selective excises on goods like fuel, alcohol, and tobacco add another 2 to 5%, targeting specific consumption behaviors. This composition renders federal revenue highly sensitive to overall economic health, as expansions in employment, business success, and consumer spending amplify collections without over-reliance on any singular sector, promoting fiscal resilience amid economic cycles. At the state level, sales taxes, encompassing both general retail levies and selective variants on items like gasoline or luxury goods, frequently lead as the primary source, comprising 30 to 40% of tax income, though individual income taxes rival them in many jurisdictions, often matching or exceeding that range in states with progressive systems. Variations across states highlight adaptability to diverse economic profiles. For instance, some jurisdictions eschew income taxes entirely, opting instead for heavier sales levies to capitalize on tourism or consumer-driven economies, while others balance both to diversify revenue streams. This flexibility allows states to respond to local conditions, such as population density or industry concentrations, ensuring that tax policies align with regional strengths like retail hubs or high-earning professional sectors. Local governments, including cities and counties, overwhelmingly depend on property taxes, which form 70 to 75% of their own source revenue, directly supporting vital services such as public safety, education, roads, and emergency response. These taxes are assessed on real estate values, providing a stable base that fluctuates less dramatically than income or sales revenues during downturns. Intergovernmental transfers from state and federal levels supplement local budgets, but the core emphasis on property underscores a focus on community assets, where rising property values from economic development can enhance funding without rate increases, fostering long-term infrastructure investments. Collectively, these levels generate trillions annually in revenue, with federal shares typically ranging from 50 to 60% of the total U.S. tax haul, states at 25 to 30%, and locals at 15 to 20%, based on projections and data through early 2026. No dominant industry emerges as the top contributor to this aggregate. Instead, broad sectors like finance, insurance, real estate, professional and scientific services, and healthcare exert influence through high wages and large employment volumes, driving substantial individual income and payroll taxes. For example, healthcare alone employs around 14 to 16% of the workforce, generating massive payroll contributions even at moderate wage levels, while professional services contribute via elevated salaries that boost income tax brackets. Manufacturing and retail add value through corporate taxes on profits and sales taxes on transactions, but the overall effect stems from diversified economic activity, where intersectoral synergies, such as tech supporting finance or retail fueling manufacturing, ensure fiscal robustness across jurisdictions. This diversified approach mitigates risks, as downturns in one area, like retail during economic slumps, can be offset by stability in others, such as essential services, ultimately sustaining government operations and public investments in a balanced manner. The role of food as the economic foundation and its taxation. Food stands as the bedrock of societal and economic stability, essential for survival and enabling progression beyond subsistence, as it philosophically and biologically precedes all other human endeavors in the hierarchy of needs. In any civilization, the reliability and health of food sources form the fundamental base, supporting population growth, labor productivity, and cultural development. Without affordable access to nutrition, societies cannot advance to complex economic structures. Modern economies recognize this centrality by structuring taxation policies to protect basic food access, exempting unprepared groceries in most states to avoid regressive burdens that disproportionately affect low-income households. This deliberate choice acknowledges food's role as a driver of broader activity, allowing individuals and families to allocate surplus resources, time, money, and energy, toward education, innovation, and discretionary consumption, thereby stimulating economic diversification and growth. For instance, when basic needs like raw produce or grains are met inexpensively, households can invest in higher value pursuits, creating a ripple effect that expands the overall economy and enhances taxable opportunities in non-essential sectors. Taxation on food varies significantly by type and jurisdiction, reflecting nuanced policy designs that differentiate between survival necessities and conveniences. Unprepared staples like fresh produce, milk, eggs, bread, and grains are fully exempt from state sales taxes in approximately 37 to 39 states as of early 2026, with recent eliminations in places like Illinois, which ended its 1% grocery tax on January 1, 2026, and Arkansas, which phased out its minimal 0.125% levy, reinforcing a national trend toward greater exemptions. However, local add-ons may persist in some areas, such as certain Illinois jurisdictions imposing replacement taxes, adding a layer of variability. Prepared items, such as restaurant meals, hot deli products, or ready-to-eat foods, face full sales tax rates nearly everywhere, distinguishing essentials from processed or luxury variants to maintain revenue while promoting affordability for basics. Distinctions extend to specifics. Plain milk typically avoids taxes entirely as a core dairy staple, qualifying for exemptions in grocery categories, whereas cakes may incur levies if sold ready to eat, decorated, heated, or accompanied by utensils, reflecting categorizations that prioritize unadulterated nutritional items over treats or confections like candy and soda, which are often taxed fully even in exempt states. Even where direct exemptions apply to consumers, indirect taxation occurs through business burdens that are inevitably passed along, embedding costs into the food supply chain. Grocery stores and food producers remit sales taxes on their taxable items, such as prepared foods or non-exempt goods, while also paying corporate income taxes on profits, payroll taxes on employee wages, and property taxes on facilities, all of which inflate operational expenses and, consequently, consumer prices across the board, including on exempt staples. In the minority of states, around 11 to 13, that still impose statewide sales taxes on groceries, rates range from reduced percentages like 1 to 4% in places such as Tennessee or Utah, to full rates in others like Idaho or Mississippi, often mitigated by credits or rebates for low-income groups to uphold equity. This nuanced approach balances critical revenue needs with social considerations, underscoring food's foundational role in sustaining societal health while strategically shifting primary tax loads to non-essentials like vehicles, electronics, or general retail goods, which generate higher revenue per transaction due to elevated values and markups. Ultimately, by safeguarding food affordability, these policies foster a healthier, more productive population capable of contributing to and expanding the broader tax base through diverse economic engagements. Economic cycles and the snowball effect of consumption. Affordable food acts as a pivotal catalyst for economic expansion by liberating household budgets, thereby facilitating a broader range of consumption patterns that drive overall growth. In the United States, where food expenditures represent only about 10.6% of disposable personal income, this affordability stems from efficient agricultural systems, subsidies, and technological advancements in production and distribution. When basic nutritional needs are met at low relative costs, individuals can redirect their financial resources toward diverse, higher-value activities, such as purchasing non-food retail goods like electronics, furniture, and appliances. This shift not only generates immediate sales tax revenue for state and local governments but also stimulates employment across supply chains, from manufacturing to logistics. The resulting multiplier effect amplifies economic activity. Initial consumer spending leads to business expansion, which in turn creates jobs and boosts wages, further fueling discretionary purchases. Income taxes, particularly at the federal level, capture these rising earnings, forming the largest revenue source and underscoring how foundational affordability in essentials propels a virtuous cycle. Without this low-cost access to basics, households would allocate a far greater share of income to survival, as seen in less developed economies where food can consume 30 to 50% of budgets, limiting the scope for economic diversification and reducing the potential tax base. Non-food consumer goods emerge as particularly reliable drivers of tax revenue due to their higher markups, perceived value, and substantial per-transaction yields, contrasting sharply with the modest costs of basic groceries. Items such as apparel, appliances, and motor vehicles often carry prices inflated by branding, innovation, and marketing, allowing for greater tax collections compared to everyday staples. For instance, a high-value purchase like a vehicle can generate significant sales tax in a single transaction, far outpacing the revenue from routine food buys, even in states where groceries face minimal or no levies. This dynamic fuels state and local coffers, where sales taxes constitute 30 to 40% of collections, and supports the recirculation of funds through government expenditures on infrastructure, education, and public services. As these investments create additional employment opportunities, they enhance individual incomes, leading to federal collections via payroll and income taxes. The snowball effect intensifies here, as recirculated funds not only sustain but expand the workforce's capacity to engage in further consumption, creating a self-reinforcing loop that broadens the overall economic base and ensures fiscal resilience. Diversification across sectors ensures the sustainability of the cycle, with no single industry dominating but rather collective contributions from varied fields amplifying fiscal inflows and transforming survival fulfillment into a driver of long-term prosperity. Cheap food underpins this by maintaining workforce health, productivity, and availability, enabling societal shifts towards service-oriented economies that now comprise around 80% of U.S. gross domestic product. Sectors like finance, professional services, and healthcare, which generate high wages and employment, contribute disproportionately to individual income and payroll taxes, while manufacturing and retail add through corporate profits. This interconnected system allows innovation to add taxable layers, such as value-added food items or luxury goods, once basics are secured. The broader food system, including processing, grocery retail, and restaurants, supports 10 to 15% of jobs, or over 22 million positions, generating wages subject to taxation and sustaining the cycle. Ultimately, this framework highlights how meeting essential needs affordably unlocks potential for multifaceted economic endeavors, where taxation benefits from the resultant vitality, fostering equity and growth in a consumer-driven society. Historical evolution of taxation systems. Taxation's roots extend to ancient civilizations, where agrarian economies positioned agricultural output as the primary revenue source, reflecting the subsistence nature of societies with limited consumer diversity. In Mesopotamia around 3000 BCE, clay tablets documented levies on grain and livestock, collected in kind to fund administrative and monumental endeavors. Similarly, ancient Egypt imposed harvest taxes on staples like barley and wheat, paid biannually to pharaohs for projects such as pyramids, emphasizing food's role as the economic core since over 80 to 90% of populations were farmers. Greek city-states taxed land productivity and merchant activities, including food imports, while Roman systems introduced rudimentary sales taxes under figures like Julius Caesar, applying broadly to markets without exemptions for essentials. These early mechanisms, often tributes or property assessments, tied revenue directly to food production, as manufactured goods were scarce and economies lacked the diversification seen today. This approach ensured rulers' fiscal needs but imposed regressive burdens, with no progressive elements to alleviate impacts on the poor. Medieval Europe continued this tradition through tithes and feudal dues, extracting fixed portions of produce, typically 10%, without regard for exemptions, as food symbolized wealth in pre-industrial settings. The church and lords collected these on crops, animals, and land output, funding religious and military obligations in a feudal framework where agriculture dominated. Early modern periods, from 1500 to 1900 CE, began shifting with tariffs on trade, including imported foods, as global commerce grew and industrialization reduced agriculture's workforce share from around 80% to under 10% in advanced nations. England's corn laws, for example, taxed grain imports to protect domestic farmers, gradually allowing revenue bases to include emerging manufactured goods. This transition marked a move away from sole reliance on food, enabling taxes on diverse items as economies evolved beyond subsistence. Modern Western exemptions for basic necessities represent a relatively recent innovation, emerging in the 20th century alongside welfare policies aimed at fairness and progressivity. In the United States, state sales taxes originated in the 1930s during the Great Depression, with Mississippi pioneering a general levy in 1932 that incorporated relief for groceries to mitigate regressive effects. Income taxes evolved from British introductions in 1799 as temporary war measures against Napoleonic threats, re-established permanently in 1842 for budget stability, influencing global adoption. The U.S. enacted its first during the Civil War in 1861, a flat rate on higher incomes that lapsed post-conflict, revived briefly in 1894 but deemed unconstitutional, and solidified via the 1913 16th Amendment enabling unapportioned levies. This amendment facilitated progressive systems, spreading amid world wars. Canada in 1917, France in 1914, Australia in 1915, and many others by mid-century for funding reconstruction and welfare. Today, over 150 countries employ income taxes, often as primary sources, reflecting a shift from ancient food-centric tributes to diversified, equitable frameworks that spare essentials while capturing broader economic fruits. Conclusion: Foundations of fiscal policy, essentials like food driving diversification and income tax dominance. The intricate web of tax revenue in modern economies, particularly as exemplified in the United States, demonstrates an unmistakable dependence on the foundational satisfaction of basic survival needs, most notably food, alongside water, air, and shelter, to generate sustained diversification and long-term growth. Policies that deliberately exempt or significantly reduce taxation on unprepared groceries and other essential staples represent a calculated strategy to preserve affordability, thereby freeing household budgets for discretionary expenditures. This surplus spending, directed toward a wide array of non-essential consumer goods and services, creates the layered revenue streams that characterize contemporary fiscal systems. Sales taxes capture the immediate value of retail transactions, while individual and corporate income taxes harvest the wages, profits, and entrepreneurial returns that arise from expanded production and consumption. Property taxes, meanwhile, reflect the rising asset values that accompany economic vitality. The result is a resilient, multifaceted tax base in which no single industry dominates. Instead, the collective contributions of sectors ranging from professional services and finance to healthcare and manufacturing ensure that revenue remains robust even amid sectoral fluctuations. This architecture underscores the principle that protecting the essentials of life is not merely an act of social equity, but a prerequisite for unlocking the higher-value economic activities that ultimately fund public goods and services. Historical transitions provide compelling evidence of this progression from subsistence-based systems to diversified modern economies. In ancient agrarian societies, where food production constituted the overwhelming majority of economic activity and consumer goods were scarce, taxation inevitably fell most heavily on agricultural output. Levies took the form of in-kind tributes of grain, livestock, or produce, directly extracting from the very foundation of survival to support rulers, temples, and military endeavors. Medieval feudal arrangements continued this pattern through tithes and dues that claimed portions of harvests without regard for exemptions, as the absence of widespread retail or manufactured alternatives left food as the primary source of taxable wealth. The emergence of industrialization and trade gradually shifted the economic center of gravity, creating new categories of taxable items, manufactured products, imported luxuries, and eventually services, that allowed governments to diversify revenue sources. By the 20th century, particularly in the United States, the introduction of general sales taxes during the Great Depression era incorporated deliberate exemptions for basic foods, reflecting an evolving understanding of regressivity and the need to protect low-income households. This shift from heavy taxation of essentials to their protection marks a profound policy evolution, one that recognizes cheap and reliable access to food as the catalyst for broader economic participation and productivity. The pivotal role of affordable food as an enabler of economic cycles cannot be overstated. When basic nutritional needs are met at a low relative cost, currently accounting for approximately 10% of disposable personal income in the United States, individuals and families possess the financial and temporal freedom to engage in diverse activities that generate greater economic value. This freedom manifests in increased demand for retail goods, professional services, entertainment, education, and technological innovations, each of which contributes to employment, wage growth, and entrepreneurial returns. The resulting snowball effect is self-reinforcing. Consumer spending stimulates business activity, which creates jobs and incomes that are taxed through individual and payroll levies, while business profits yield corporate income taxes. Government expenditures funded by these revenues, whether on infrastructure, education, or public services, further recirculate money into the economy, sustaining the cycle. In this framework, the food system itself remains economically significant, employing millions across farming, processing, grocery retail, and food services, and contributing both directly and indirectly to taxable income. Yet its greatest contribution lies in its capacity to liberate human potential, transforming a society from mere survival to one capable of producing and consuming a vast array of higher-value goods and services. Cheap food, therefore, functions not only as a biological necessity but as the strategic foundation upon which the entire modern taxable economy is constructed. In synthesis, the efficacy of contemporary taxation systems depends critically on the cultivation of multifaceted economic bases, where the fulfillment of survival needs propels continuous societal advancement. As economies diversify further into services, technology, and knowledge-based industries, the protection of foundational essentials ensures that revenue streams remain resilient and adaptable to future challenges. This balance between safeguarding basic needs and harnessing the prosperity generated by expanded activity offers a model of fiscal sustainability that prioritizes both equity and growth. The interconnected fiscal landscape that emerges, where federal income taxes capture national wage and profit growth, State sales taxes benefit from consumer dynamism, and local property taxes reflect community development, illustrates how deeply taxation is embedded in the social contract. By maintaining affordable access to food and other essentials, societies not only meet immediate human requirements but also secure the conditions necessary for enduring economic vitality, equitable revenue generation, and the shared prosperity that defines advanced civilizations.